Hello everyone. Now let's start with our third topic, that is measure of risk. Under measure of risk, what we're going to cover are total return over multiple periods with the help of arithmetic mean and geometric mean. We are focusing on the concept and the formulas that we'll be using for this purpose. Then measuring the historical risk, criticism of variance and standard deviation, rationale for standard deviation, and measuring the expected return and risk. So, three things which we are going to cover. First one is how to calculate the multiple periods return with the help of arithmetic means and geometric mean. With the help of arithmetic mean and geometric mean, then we are going to calculate the historical return, and then we are focusing on the expected risk and return. Now, what is arithmetic mean? Arithmetic mean or arithmetic average corresponds to a sum of linear returns observed dividing the result by the number of observations. So, we can see that at summation of Ri divided by n in simple terms. So, summation here we are representing with the help of R bar, that is R bar, where R bar is the arithmetic mean. So, what we are going to do is we have to calculate whatever the return that is available over a period of time and add that, and then we have to divide it with the number of periods. Suppose for last 10 years we are calculating this, so 10 years return will be added on, divided by 10. We are going to get the average return. So, here is an example. Suppose the total return for a particular stock A over a period of 5 years as it given below. First year we are getting 13%, second 14, then third year 12, fourth year 17 and fifth year minus 14. We are going to add this thing and divide it with total number of period is 5. So, 42 divided by 5, we are getting a return of 8.4%. So, this is a simple calculation of return, that is arithmetic return or arithmetic mean. Why it is useful, or what is the usefulness of calculating arithmetic return? Estimating expected return, it is useful for estimating the average return and investment might generate over a period of time. From the background, we can see that if we are getting 8.4% in last 5 years, the investor might expect that we are going to get around 9% in next 5 years or around 10% in coming 5 years. So, on the basis of this, we can say that if we calculate the arithmetic mean or arithmetic returns, we can predict the future also up to a certain point. Then short-term forecasting, suitable for short-term forecast or when returns are independent of each other, meaning the orders of returns does not matter. Here in this case, suppose the third year return, if I move it to fifth year, or fifth year return I move it to second year and puzzle them all, then also the return is going to be the same. But if they are associated or there are chances of autocorrelation, in that case arithmetic return or arithmetic mean is not suitable. Volatility underestimation, it does not factor in the effect of volatility over period, making it less reliable for analyzing compound returns because we are not considering the effect of time period. So, in this case that may lose the significance. And also it is focusing on short term forecasting. So, we are not focusing on the long term returns or long term gains that we are going to get from the particular instrument. So, volatility underestimation is a basic concern with this particular concept. Next concept is geometric mean. In arithmetic average return assumes that amount invested at the beginning of each year is same. So, in case of arithmetic mean, we are focusing that every year we are going to invest only 1000 rupees and whatever the amount of return we are getting, we are not adding in that particular thing. But in case of geometric mean, we are actually compounding this particular effect. So, in case of investment, even without reinforcement or withdrawals, the base value changes every year. As I mentioned in my first lecture also, that suppose you have invested 1000 rupees and you are getting 10% return, next year it is going to be around 1100 rupees you are going to invest. Similarly, again you are going to add 10% return on this 1100 and whatever amount is coming you are going to invest in. So, you are having a compounding effect. So, geometric means consider that particular thing. So, with the geometric mean, these results will be added to the amount invested at the beginning of the following year, creating the compound capitalization effect, which is not possible in case of arithmetic mean. So, the return of geometric average thus provides a more accurate assessment of the return, because we can focus on the value or the growth value of the investment. So, the formula is geometric mean equals to 1 plus r multiplied by 1 plus r2 for the second period till the time we are investing in, to the power 1 by n minus 1. So, for this example, we can consider this example. For 5 years, we are getting 13%, 14%, 12%, 17% and minus 14% return. It is available in percentage. Now, we need to calculate the relative return. It is coming around 1.13. That is simply adding this particular one in it. So, we are getting this much return. Now, what we have to do? We have to calculate the summation of this particular value. It is coming around 1.452 to the power 1 by 5, as it is mentioned, because 5 years period is there. We have to take the under root of this particular value. We are getting 1.0774 minus 1. It is coming around 7.7% or 7.77%. Okay, so this is the compounding effect, or we can say the geometric mean of the investment. Now, what is its usefulness? Accurate long-term performance. We can actually, in case of arithmetic mean, we are not accumulating the returns which we are getting, or we are not adding back. But in case of this particular geometric mean, we are adding back the amount of return we are getting. So, there is a compound growth effect which can be easily measured with the help of geometric mean, which is a basic fall in arithmetic mean. Second, accounts for volatility. Since we are considering the compounding effect, we are also considering the volatility that is associated with that investment. Better for comparing investment with volatile returns or different return distribution. It is easy for the investor to have a better comparison as compared to arithmetic mean. So, geometric mean is going to give you more realistic overview of the investment. Now, coming to measuring the historical risk. Historical risk, as we already mentioned, it is associated with the risk that we have in the past, or we can calculate from our past prices or the past data of the particular instrument. So, historical risk refers to the measurement or analysis of risk associated with an investment or portfolio based on the past performance. It looks at how much returns on asset or portfolio have fluctuated over a period of time, providing insight into the volatility or uncertainty experienced in the past. So, whatever we have achieved till now, with the help of historical risk, we can calculate that. For calculating historical risk, two measures are used, that is variance and standard deviation. The formulas are mentioned over here. Variance is summation of Ri minus R bar, that is the expected return or average return, square root, divided by n minus 1, n is a number of period minus 1, and standard deviation is the under root of variance. So, that is shown over here. It is a variance of the return, and standard deviation is shown by the sigma. So, Ri is the total return or the return of the stock for a period of I, that is 1 to n number of period, that is we are going to consider. R bar is the arithmetic mean or the average return of the particular series, and n is the number of periods that are under consideration. Now, what is the criticism of the variance and standard deviation? Variance consider all deviations, negative as well as positive. Okay, so investors are basically considered more about positive return, but they take consideration of negative return also. It is not so that investor only favor the positive returns or low risk investment, they also consider high risk instrument too. So, negative and positive deviations both are considered by the investor. Hence, some researchers have argued that only negative deviation should be considered while measuring the risk, but investor consider both the positive and negative side of the return. Then when probability distribution is not symmetrical around its expected value, when we talk about the bell-shaped normal distribution, if it is not symmetrical around the expected value, the variance alone does not serve the purpose. In that case, we need to seek for the skewness of the distribution, because it is going to explain in much better way. We are not going deeper into this concept, because when we talk about the bell-shaped distribution or skewness of a particular portfolio, we need to check into the different aspects also. So for that purpose we are not considering, because it's a component of econometrics. For further detail you have to go through the econometrics books, where it is explained in much better way. But in case of standard finance or investment management, we basically consider that the risk is symmetrical and the probability distribution is normal. Rationale for standard deviation: if variable is normally distributed, its mean and standard deviation contains all the information about its probability distribution. So if it is a normal distribution curve, in that case we can consider all the things, and on the basis of that we can take the decision. In real life situation, it may happen there is no normal distribution, or the shape of the curve is not perfect. In that case we have to take the guidance of econometrics and other econometrics tool for calculation of risk and return, and they are quite higher in statistical knowledge. If the utility of money is represented by a quadratic function, a function that is commonly suggested to represent diminishing marginal utility of wealth, then the expected utility is a function of mean and standard deviation. If we consider that, in this case, if we consider the quadratic equation, or we can simply say the function of money, it's considered of two components, that is mean and standard deviation. In simple terms, we considered standard deviation first because we think that the distribution is normal. Second, we think that money is a representation of quadratic equation, that is a composition of a mean and variance of on the basis of utility of wealth. And third, standard deviation is analytically more easily traceable. That means we can easily trace out what is the variance, how much is the variance, or what is the standard deviation of a particular series. That is more easily calculatable, and for normal investors it is easy and convenient to calculate the standard deviation. There are other tools also that are quite high in their precision value, but they are quite difficult for normal investors who don't know about mathematics or statistics and not aware about the different calculation tools and techniques that are available. They simply consider standard deviation. It is a standard tool for calculating the risk. Now coming to measuring the expected return and risk. So expected return is a return that weighted average of all possible returns multiplied by their respective probabilities. Here we are considering that expected return. Expected return means we are expecting that may be coming in future. So there are chances of probability assigned to it. The occurrence chances associated with the amount of return need to be associated with a particular percentage of return. So ER is the expected return from the stock, RI is a return from the stock under state I, and PI is a probability of state I occurs, and N is a number of possible state of the world, or we can say the N number of series or number of observations that are available. Standard deviation of the return. Now when we talking about expected return, we have to consider the expected risk also, or we have to calculate the expected risk of the series. So risk is commonly measured by the variance or standard deviation, which we considered in historical case also. In case of expected return, we need to calculate on the basis of expected return. In case of normal series, that is for historical data, the calculation is quite easy. But in case of expected series, we need to consider the probability for return, and in case of risk, we have to consider the expected return, which we are considering for that particular series. Series in the sense, how much return we are going to get in next coming, suppose we have taken a 5 years period into consideration in next 5 years period. That will be the series. With the help of numericals, we are going to explain this concept in a much better way. The variance of the probability distribution is the sum of the squares of deviations of actual returns from the expected return weighted by the associated probabilities. So where standard sigma square is the variance, RI is the return of the ith possible outcome, PI is the probability associated with ith possible outcome, and ER is the expected return, which we are actually calculating first. Then on the basis of that we are going to calculate the standard deviation of the series. Now, important concept is risk return trade-off. The risk return trade-off basically reflects the balance between the level of risk the particular individual person or particular investor or portfolio manager is considering from an investment point of view, and he is willing to take that, and how much potential return he is expecting from his investment. So that is the trade-off between risk and returns. So we already know higher expected return typically comes with higher risk. So if you are expecting a higher return or you need a higher amount of return, in that case you have to consider or you have to take higher amount of risk. And if you are considering that I should be at a sufficient return which is quite low in nature and I am not considering a risky instrument and I am not able to take risk, in that case lower expected returns are considered with instruments which are carrying a lower level of risk. So risk return trade-off basically is associated with the concept that if you take higher amount of risk, you are going to get higher amount of return. If you take low amount of risk, you are going to get low amount of return. So it's not that if you take low risk, you are getting higher return, and you are taking higher risk, you are getting lower return. This may be possible, this situation, low risk and high return is quite unnatural. But there are chances that you are taking high risk but you get low return depending upon the market situation. But in general, when we talk about risk return trade-off, we simply say that higher risk is associated with higher return and lower risk is associated with lower return. So investor need to trade off between these two situations. So what is the importance of expected risk and return? So investment decision making, investors use expected return because on the basis of that they can evaluate their situation and the particular financial instrument. If they consider that expected return is good enough, it is going to give them better return in future, then only they are interested in investing. So they need to align their financial goals with this concept of expected return. So for instance, an aggressive investor might prioritize high return stocks despite the risk, while conservative investors might prefer stable bonds with lower risk. So the purpose of risk return trade-off or for fruitful investment, we need to consider the concept of expected return. Risk tolerance, if investors align their investment with their risk tolerance, in that case, suppose my risk appetite is low and I am a risk averse investor, in that case I am going to prefer instruments which are low in risk, that is bonds or FDs or debentures. Portfolio construction, for portfolio construction purpose also we need to consider the expected risk and return. When we are talking about expected risk and return, we are basically talking about security analysis. On the basis of this security analysis, we are going to construct our portfolio. So it is very important for an investor to calculate the expected return of the investment as well as calculate the risk of the investment, and then only if it is aligning with their investment goal or if aligning with their risk tolerance level, then only they are going to select that particular instrument for portfolio construction. Now let's start with the calculation of historical risk and return. So in this, going to do some numericals. With the help of the numerical, I am going to explain the concept. So the calculation of historical risk and return, that is the first thing which we have considered in our previous lecture, that on the basis of average returns, we are going to calculate this. So what is the formula? So returns are provided over here. The simple returns are provided. The first year we are getting 15%, we are getting 15%, second year 12%, 20%, minus 10%, 14% and 9%. So take out the summation of this particular return, it is coming around 60. Divided by 6 years are there. So if it is covering around 6 divided by, so we are getting the R bar, that is the average return, it is around 10. So now deduct this particular return from the average return. So Ri minus R bar. So here I have presented R bar with the help of this R dash bar. Okay. So this is basically R bar, or we can say average return. So 15 minus 10, here 15 minus 10 we are getting 5, 12 minus 10 we are getting 2, similarly 20 minus 10 we are getting 10, 10 minus 10 is around 20, 14 minus 10 4, 9 minus 10 is minus 1. So we get the deviation, deviation is Ri minus R bar. Okay, now square root of this deviation, 25, 4, 100, 400, 16 and 1. So total of this is 546. Now apply this particular formula, that is summation of Ri minus R bar whole square divided by n minus 1. So we are getting around 109.2. Similarly, if we take the case of this is variance and this is standard deviation. So we get under root of this around 10.45. So if we simply explain this, we want to explain it further, then 446 divided by n minus n1 is a formula, n minus n1, n is around 6, 6 minus 1 that is 5, 446 divided by 5 equals to whatever it is coming, under root of that value we are going to get around 10.45 standard deviation. So average return in this case is 10%. If we take return, Ri is 10% and standard deviation is 10.45. So this is a quite risky instrument. But how are we going to compare it? It is not possible on the basis of this we are going to give a judgment. We need to compare it with other financial instrument, then only we are going to compare and select which instrument is best for us. Just by seeing the standard deviation or return of single security, we are not going to consider our investment decision. We have to compare it with other instrument. So this is a simple formula where we are going to calculate the risk and return on the basis of historical data. So if you want to consider this, you can take the examples or take certain industries, and on the basis of that you can select 5 stocks. Suppose you take the pharma industry, and from that pharma you select 5 stocks and then go for calculation of average return and standard deviation, and then compare these 5 stocks, and on the basis of that you can find which particular company is good for investment. Now calculation of expected return and risk. Expected return and risk calculation in general situation, or we can say in normal situation, is not possible because we have to assign certain amount of probabilities. Here in this example, you can see the probability of occurrence is provided by the person who have framed this numerical. So it is provided to us. But in case of real life situation, we cannot assign the probabilities, and it becomes difficult for the investor to consider the scenarios and the probabilities, and then on the basis of that going for calculation of expected return. So what we normally go for? We normally calculate the historical risk and return, and on the basis of that we compare the securities and select the securities. But for the calculation, suppose the fund managers, they can have the scenarios available to them. They have high-tech computers available to them, and with the help of Excel, they create different scenarios, and on the basis of that scenarios, they can calculate the expected return of the portfolio as well as the security. But for normal investor, it becomes little bit difficult and tricky to calculate these probabilities and situations. So now consider this example. So we have 3 economic conditions: boom, normal and recession. The probabilities values are 0.3, 0.5 and 0.2. The return of ABC Limited is 15%, 12% and 7% in 3 economic situations. Similarly, XYZ company is getting 17%, 14% and minus 6% return. Now, what we have to calculate? We have to calculate the expected return. What is the formula? Ri into P. It's a summation of n number of series. So, Ri into P, that is we have 5n. So, 0.3 we can consider, go back and check, 0.3 into 15, 0.5 into 12, 0.2 into 7. So, we have to consider this thing for ABC company. We have multiply it and we are getting around 11.9%. Similarly, we have calculated for 0.3 into 17, 0.5 into 14, 0.2 into minus 6. We are getting a return of around 10.9%. So, this is our expected return from these two securities. Now, on the basis of this, can we consider that ABC is a good security? No, we cannot consider just on the basis of return that ABC is a good security. What we have to consider then? We have to calculate the standard deviation or variance. On the basis of this, we need to decide which security is good for investment. So, now we are going to calculate the risk. If we check the formula, if we are going to expand this formula, PI, then RI, then expected return. Three things are there. First we have to do, we have calculated the expected return. Now we have to consider return minus expected return and then square root of that and then multiply with the probability value. So, with the help of this table, we are going to consider it further. So, PI is 0.3, 0.5, 0.2, or we can say simply say 30%, 50%, 20%. RI of the particular company is 15, 12, 7. Now, RI into this we are going to multiply, we are getting PI into RI, that is 4.5, 6 and 1.4. Now, consider RI minus ER. RI minus expected return, just go back and check what is the expected return of ABC, 11.9%. So, on 11.9% if it is deducted from 15, we are getting 3.1, 0.1 and minus 4.9. Now, just square this out, we are getting 9.61, 0.01 and 24.01. Now, multiply with the value of probability. So, we will get this. So, total is 7.69. So, on the basis of this, the variance is 7.69. Under root of this, we can say under root of this particular variance, we are getting 2.77 as the standard deviation. So, if we consider the second example also, just check out what is the value of variance and then compare it with this particular return. So, if the ABC company, the return is this and variance is your 2.77. Now, for your work, I am considering that you will going to calculate the standard deviation and check which particular stock is more risky or more fruitful for an investor. So, try to consider this example and calculate the standard deviation of XYZ company and check which company is best for investment on the basis of risk and return analysis. So, with this we come to the end of this concept. In next chapter we are going to do some numericals and we focus better on this particular concept. Thank you.